All right, today we are diving into something that is quite literally the language of business and the global economy. We're talking about accounting standards. Now I know, that might sound a little dry, but stick with me here, because understanding these rules, well, it's absolutely essential if you want to know how businesses really work, how they compete, and how they win. So, let's get right into it. To really get why these standards are so incredibly important, let's start with a simple question. Think about it for a second. Is business a game? I mean, you've got different players, right? You have complex strategies, big risks, and of course, you've got winners and losers. It's a pretty powerful way to look at it. And if we agree that business is a kind of game, then every good game needs one thing more than anything else.
And that one thing is a rulebook. In this massive global game of business, accounting standards are that official rulebook. They're what tell you how to keep score. They define how you count your wins, how you recognize revenue, how you value what you own, and how you report your profits. It's all about making sure everyone is playing on the same field by the same set of rules.
Now, just for a second, imagine the alternative. Imagine trying to play a game where every single player just makes up their own rules as they go. It would be total chaos, right? One company might say they made a sale the moment a contract is signed. Another might wait until the money actually hits their bank account. A third company could decide to count revenue based on a future guess. How on earth could you tell who is actually doing well? You couldn't. It would be impossible to compare anyone, and you wouldn't be able to trust a single number you saw.
And that chaotic world, well, that's precisely the problem that accounting standards were created to solve. They are the agreed-upon rules of the game, designed to bring order, logic, and most importantly, clarity to the incredibly complex world of business and finance.
So, let's put a formal definition on it. What are we actually talking about here? Accounting standards are a set of guidelines and principles that companies must, and that's the key word, they must follow when they put together their financial statements. So think of this less like a friendly suggestion and more like the fundamental grammar of financial language. It's the framework that makes sure everyone is speaking the same language. So this rulebook, it really has three big goals. First up, consistency. This makes sure a company reports its finances in the same way year after year so you can actually track its performance over time. Second, we have comparability. This is what lets you take the financial reports from two different companies, lay them side by side, and make a fair, truly apples-to-apples comparison. And finally, number three, transparency. This gives investors, and really all of us, a clear window into what's actually happening inside a business, its true financial health.
Of course, a rulebook doesn't just appear out of thin air. And a game needs referees to enforce the rules. In the world of finance, this role is played by independent organizations whose entire job is to set and maintain the accounting standards that govern business around the world.
And there are really two main referees you need to know about. Here in the United States, the big one is the Financial Accounting Standards Board, or FASB for short. They create the rules known as GAAP, which stands for Generally Accepted Accounting Principles. Now, for most of the rest of the world, the main player is the International Accounting Standards Board, or IASB. They issue IFRS, the International Financial Reporting Standards. And while they're both aiming for the same goal of clarity, they have different philosophies. GAAP is known for being very rules-based. It's like a detailed manual with specific instructions for almost every situation. IFRS, on the other hand, is more principles-based. It provides a broader framework and expects professionals to use their judgment. For example, under GAAP, a U.S. company can use an inventory method called last in, first out. Under IFRS, that's not allowed at all. Little differences like that can actually have a huge impact on a company's bottom line.
Okay, so we've got the rule books, we've got the referees, but what's the real payoff here? Why should any of this matter to you, whether you're an investor, an employee, or just someone who wants to understand the world? Let's talk about the real-world impact. This quote really hits the nail on the head. The absolute core benefit is comparison. Think about it. Without these standards, trying to compare two companies would be like trying to compare one car's speed in miles per hour and another's in kilometers per hour. The numbers themselves are useless without a common framework to understand them. Accounting standards provide that common language, that common framework. So we're always comparing apples to apples. So let's just quickly recap why this is such a game changer. These standards give us those true apples-to-apples comparisons, which lets you judge who is actually performing better. They guarantee consistency over time, so you can see if a company is really growing or if it's just playing games with its numbers. They create that transparent window into a company's real financial situation, and all of this together builds the single most important ingredient in any economy: investor confidence.
And this right here, this is the main takeaway. It's so easy to dismiss these standards as just some boring technical rules for accountants, but they are so much more than that. They are the invisible architecture of trust that our entire financial system is built on. Without that shared trust in the numbers, people stop investing, capital dries up, and the whole economic engine just starts to grind to a halt. That's how critical this is.
So, as we wrap up, it's worth thinking about what's next. We've spent decades building this incredible system for reporting what has already happened. But now we live in an age of real-time data, of artificial intelligence. So what does the future of financial transparency even look like? How will the rulebook have to change for this new, much faster game? That's the big question we'll leave you with today. Thanks for joining us for this explainer.